Hey guys, welcome back to this channel. Welcome back to our Thursdays where we talk about first-time home buyers. And I'm so excited to share this episode with you as we talk about grants versus programs. What are some of the options that you have to get those first keys to your first home? Now, before we go on with today's episode, I'd love for you to join us here on this channel. Hit the subscribe button and subscribe to our channel. Hit the bell for further notifications of our upcoming videos. There's a lot of good stuff that we are getting ready to put out, and we're gathering everything and just so excited to share it with you guys. So if you'd love to join us, please do. We'd love to have you. So today we're going to be talking about grants and programs. And although it kind of sounds like there's a huge difference already when you just say grant versus program, once we start to talk about different details in both categories, it's so easy to feel like you're just walking into this forest and you don't know where we're going exactly. Like, is this a grant? Is this program? Is this a one-time thing? Or do I get it, monthly? What is it? And so this is why we thought it's important to just separate the two and then take some time to talk about grants and take some time to talk about programs. Because one, the grant, is meant to be kind of like a band-aid to aid you into qualifying or fulfilling the duties that you have to get into a program. And the second, the program, is the actual pathway. It's like a 15 or 30-year pathway into owning your first home. So both are important, but let's find the difference and let's talk about it. Now, think back to college years. A lot of people are used to thinking of grants as being purely for research or for going to school, but it also applies to first-time homeowners. So grants are something that are typically given because somebody qualifies for it, but you, as the person that receives the grant, are not expected to pay it back. It's not a loan. It's not a loan program where there are things that you need to do. It's a grant where you just accept it, say thank you, and move on with your life. Some of the rules for a couple of these programs are that you have to live in your home for at least 5 years, and we'll cover those to make sure that we highlight the ones that do require it. But most of these are a one-time thing that do not require you to do anything except for qualify for them. Now, a good lender will walk you through each of these options and will present to you the things that are available for you. A good buyer's agent, a real estate broker, will be able to negotiate the purchase of your home with seeing based on how the economy is going, seeing what these particular sellers are willing to give, or maybe what sellers in general are starting to do, again, based on the economy, and seeing what provisions they can include in the offer when you first submit an offer. And as buyer's agents, we're here to provide you with options and to educate you. And then you can say, yeah, I think that asking for this whole bundle may be too much, but I would love for them to help out on some of the closing costs or this. And there's rules and regulations. But if we educate you on what your options are, then you will be very well equipped to know what to put into your offer. So it kind of, to qualify for these things, it goes hand in hand with presenting the right offer and then waiting for the sellers to accept your offer. And then once you're past the offer stage and it's called in a mutual contract, then it's up to your lender to kind of continue this conversation with you and to walk you through some of the options that you have and what makes sense to you. So two-part approach from both sides, but getting you into that first home. So since I just mentioned it, let's cover sellers' credits first. Seller credits can be applied towards your closing costs up to a certain amount. They can be applied towards repair costs if you have an inspection done and it reveals that the roof is in really bad condition and the sellers are willing to say, hey, we're already in a mutual contract and we want to see this deal close. we can cover half of it or all of it, and whatever the negotiation conversation is at that point, because it is part of your real estate agent's job to help you through the process and to educate you so that when you negotiate with the sellers, you guys can come to a mutually beneficial position, so that when you do that, a seller can provide further finances to cover repairs, or in the beginning, towards closing. So this one is not exactly a grant, but as we're trying to put ourselves in the mindset of a first-time buyer, thinking that besides grasping onto all of this information, you're also most likely trying to figure out where does all of this fit in the process. So this is why we started off with the seller's credits first. This next one, I want to very, very straightforwardly make sure that you hear the caution and the alarm bells so that you're aware of the program, but you're also aware that I am not for this program. I do not think it is advantageous or the best thing to do for any buyer, but especially first-time buyers. And I would caution you to have very honest discussions by yourselves at home with your family, or if you're buying the home yourself, which is totally fine, but you can talk to a financial advisor and get the real picture of your finances first, and then talk to a trusted lender and someone who's a good communicator, someone that will relay all the facts to you, because I do not want anyone to ever take this option lightly. Okay? With that minute-long cautionary intro, the next one is a down payment loan. You heard that right, I said loan. So normally when you buy a house, the more of a down payment you bring in, the less of a loan you have. Because if a house costs $430,000 and you bring in $10,000, then your loan will be $420,000. So you bring in $10,000 and then the rest of $420,000 you will have to pay off during the lifetime of the loan, whether it's 15 or 30 years or anything else. Now let's say you bring in $30,000, and so the house still costs $430,000, but you bring in $30,000 and you're left with a $400,000 loan. This can mean lower monthly payment. It can mean that you qualify for better APR based on maybe your credit history is better, maybe you earn more money, and so you're on time with all of your payments, and all of that can affect it. But the more you bring in, the better off you should be, theoretically. Sometimes there's a very minute or small difference between one qualifying for one program versus qualifying for another. And when you speak to your lender, a trusted, good, experienced lender, and I can refer you my lender partner, I don't get anything out of it, but I just know that you're in good hands, and he's someone that will provide you all of the info that you need to feel empowered to make the best decision for yourself and your family. So there is a point where you may qualify for a different program if you just give a slightly larger down payment. Do I think that it is always a good idea to jump on that better program? It may sound better, but if you have to take out a loan, that already should tell you that you may not qualify for this program without taking out more debt. So I would caution you to just be honest with yourself about your finances. There's nothing wrong with going into the conversation with a lot of knowledge and a grain of salt of this is all that we can qualify for now, and we're gonna get our first home and we're gonna work on our finances, and 5 years from now or 3 years from now, maybe we can refinance, maybe we can get into a different home, or maybe we'll need to move, but you will be in a stronger position eventually at some point, and that's totally fine. So the down payment loan, it is usually and should be interest free. So then you're like, okay, wait, Sasha, you're telling me that I can get a loan, not just for the mortgage, but also for the down payment, and it's going to be at 0 APR. What's the harm in that? So there are two ratios that we look at when you're buying a home. And to be honest, as a real estate agent, I don't look at those ratios because I look at the negotiation part of the deal, and then everything is passed off to the lender, and my job is to make sure that the deal continues per terms, and then if anything needs to change, that I communicate effectively with everyone and timely, and then we can renegotiate, or your lender may need to be aware of some things. And so these two ratios are more on the lender side. They're more important than they are on the real estate side. But on the lender side, there's two things that they look for: the debt to income ratio. And when they look at that ratio, they say, well, how much can you qualify for that you can continue a healthy lifestyle and be able to pay all of your debts. This is why if you have a lot of credit card debts, if you have a couple of car loans and things like that, then you may or may not qualify to buy a house. So when you look at, but talk to a lender first. And so when you look at debt to income ratio, they're not going to take you above a threshold that is established for the lenders, because you cannot spend like 50, 60, or 80% of your income on your housing costs and then expect the person or the family to be able to have food on the table and pay for the electricity bill and pay for water and like to be able to sustain themselves. So this is why there's a certain ratio where we can't take you more than that, that you'll hear about. The other one is loan to value. The value of a home, your loan can't be more than the value of your home, or else you'll be in the negative. And it happened during previous crises that people's value would drop and the loan amounts that they had would be higher than the value of the home. But that's not how it was when they were purchasing the home. It depended on the economy at the time, and if people could keep continuing to pay for their mortgage through the economic crisis, they were fine, because eventually the house values regained, and all of a sudden now they have equity and they're, strong homeowners. What the bank wants to see is that they're not putting you at jeopardy or their loan in jeopardy and providing you a greater loan amount than the value of the house. And so there's also a cap as to the ratio between how much you can borrow versus how much the house is worth. So a down payment loan will increase this debt, will increase this loan amount. And if you can only pay 3% to buy a house, 3% down, then it makes no sense for you to take out even if it's an interest-free loan, to take out a down payment loan to make sure that you have 20% down payment coming in, because the bank will know. And the bank will say, well, you're not really giving us 20% because you have this debt over here that's giving you this money in hand. So that's an important one to know. Please, please, please speak to as many qualified people as you need before taking on something like a down payment assistant loan. Now, the next three programs are very much straightforward grant types. So you are not required to pay anything back. People are willing to give you a cash grant, and all you need to do is just qualify based on income levels, being a first-time home buyer, and living in the home for a certain amount of years. These programs are made so that communities are built and strengthened. So this is why a lot of these programs have like a 5-year minimum that they want you to live in there, because they don't want you to qualify to buy a house, move in, and then 6 months later say, hey, I have a little bit of equity saved up, I want to sell the home, and I want a downtown condo all of a sudden, or something like that. They would love for you to keep to continue creating these communities, and it takes time to create a community. So some of these programs only require 36 months, others require 5 years. Just be aware of what it is, but I think these are great help for first-time homebuyers. So the first one out of the three are state and local government cash grants. These grants are, they range from the state to your area to your city sometimes, or counties, and they can range from $500 to $50,000. I think that states that are more critical in seeing people not being able to meet the housing costs that are around them give more, versus states that have a pretty good balance or ratio, they give a little less. It also depends on you meeting the credit report, like a credit criteria, not just credit history, but credit score. That's the term. Thank you. So credit score, and then meeting the income levels. You want to see typically at least one person in the family being full-time employed, and then also the income has to be not zero, but not over a certain threshold. But if you qualify, they're great opportunities, and why wouldn't you want to know about them? Why wouldn't you want to take advantage of them? This is something that definitely your lender will be able to tell you all about. The next one is called the National Home Buyers Fund. This is brought to you by a nonprofit. It's a national nonprofit corporation, and it's meant to encourage homeowners to stay in their homes for at least 5 years. So part of the requirements is to make monthly payments and stay in your home, stay in your community for at least 5 years. And in exchange for that, they're more than willing to give you up to 5% of your purchase price. You heard that right, up to 5%. Now, their main objective, their main goal is to create the sense of stability within communities. So this is why they ask you to stay in the community for at least 5 years. You can stay longer, but they just don't want people jumping around, taking advantage of grants when they're not intending to stay there. But this is a great opportunity because most people stay in the same, I don't want to say just city, but city or locality or county for more than 5 years. So taking advantage of something like this can be really beneficial when you think about it being up to 5% of the purchase price. Now, the next one that we're going to talk about is called the Down Payment Towards Equity Program. So a good thing to know about this program is it awards first-time homeowners up to $20,000 in cash grant, and an additional up to $5,000 for those that have certain backgrounds, social or economical backgrounds that are more disadvantageous than regular first-time homebuyers. And this was an act before, it is now a bill, so it's one step closer to becoming a reality for us, and it just needs to be passed. Based on what I've been hearing, it is a likelihood that it will be passed early next year in 2023, but we are waiting for this to become reality. Now, one good thing about this, and there's actually two good things, but the first one is once it is passed, it's going to apply retroactively. So if you purchased your home from I think January 1st of 2021, so anytime during 2021 and 2022, even though the bill will become a thing, will become law in 2023, it will still apply to you retroactively. And what happens is you mark on your taxes, and it's going to, everything that we do, we have it as a history in our taxes, and it will just be applied in the year that you are eligible to receive the benefits of it, but they will look back in 2021 and 2022, so you're not losing on anything by still making a purchase even this year or early next year before it actually becomes active. The other positive thing about this grant is that it is not something that's super new. It's a very good idea. I'm fully for it because even though it contributes a little bit towards inflation at the end of the day because more money is printed, this is a great help to first-time home buyers. And I think that there's nobody else that is more deserving to own a home than first-time home buyers. There's something so special about it, and you're creating stability in your finances. You're creating not just stability, but a sense of home for your family. And all that to say, in 2008 and 2009, there was a similar program in place. So once this does become an actual program that's active, it is not something that everyone has to scramble around to figure out how to do. There's already infrastructure in place because there was a similar program earlier on, like I said, 2008, 2009. So once this program is in place, it will be handled very well, I think. It will be carried out very well. So you don't have to go searching for it. It's just going to be part of either your closing process or your tax process at the end of the year. So we know about Fannie Mae and Freddie Mac as an organization, like national organizations that help and subsidize housing and kind of set the standards for loans and how much debt you're allowed to have and all of that good stuff. Well, their parent organization for both of them is the Federal Housing Finance Agency, FHFA. And if I can get those letters in that order for the rest of this video, I can be coffee free for the rest of the day. But chances are a couple of lattes will be in order. So the FHFA, yes, is giving grants, and this is not a cash up front. It is a way to help you with your mortgage rate. Now, when we talk about mortgage rates these days, everything that we hear is that they keep increasing and increasing. So this is FHFA's way of helping first-time homeowners by decreasing the rate. In order to qualify for it, you don't just have to be a first-time home buyer. You have to qualify based on your income, credit score, and a few other factors. But the better credit, the better FICO score you have, and the more money you can bring in as a down payment, signals to them that you are in a stronger financial position. So whereas other programs, you want to be better to qualify, this program is kind of going backwards into if you have lower scores and if you really can't bring in a whole lot towards down payment. Like bringing in 3% qualifies you better for the program than bringing in 20%. Now, am I saying that if you have 20%, don't bring it to the table? No. What I'm saying is if you have 3% and that's all you have, sometimes I've talked to first-time home buyers so many times that they feel like they don't qualify enough because they don't have, they look around, and they think, I don't have enough as this guy and my score is not as good as hers. And so they compare themselves, and really the old saying of do not look to the left or to the right applies here. This program from the FHFA is there for you, that even if you can just bring in a 3%, and if your FICO score sucks, they will be able to help you more, up to 1.75 percent points on your, oh boy, where are my words today? Off of your interest rate, which will affect how much you pay mortgage for the next 15 or 30 years of your life. So this one is a very, very good program to jump on from the start and not to just automatically assume that you do not qualify for any of these programs. In fact, any of these grants Take advantage of them. What's the worst thing that can happen? That you don't qualify for it? Okay, you may qualify for just a little bit. Even if it's a 1/4 point difference, if it's a 1/4% of interest that is lowered, you're going to see that reflected every single month. You're going to be able to save more money for your family every single month, or pay off your mortgage faster potentially. So go ahead, take the chance. Take the extra little bit of time to talk about this with your lender to see how you can qualify and how you can go through the process of having this applied to you, because these grants are amazing. And guess what? Everyone's talking about how hard it is to buy a home right now. Everyone's talking about how hard finances are. Well, somebody's finally taking notice. These programs by the FHFA, I said that right, this first-time homebuyer mortgage rate discount is a way of them helping you through this process, knowing that it is hard to own a home. It is hard, and you have to make sacrifices to be able to, pay your bills on time, to keep your score up, to get out of debt, to provide financial stability for your family. But it's meant to be a little help to help you through this process, because you're heading in the right direction. So this one is a very good one to not just watch out for, but to also take advantage of, because everyone wishes they could qualify for this program, to be honest. Now, this next program is called Good Neighbor Next Door program. So in order for you to qualify for this, you have to either be a pre-kindergarten to 12th grade teacher, a firefighter, an emergency medical technician, or a law enforcement officer. These professions help to not just build our communities, but help to stabilize and nurture and support our communities on a daily basis. So the Good Neighbor Next Door program is something that, to be honest, makes us smile every time, because we know that good intentioned people are flocking to our communities, and it gives us good feeling of finally there's a way to help those that are helping us every single day. And we just, teachers have it rough, law enforcement have it rough, so do EMTs and firefighters. Like, you guys do so much for us that this program, we just wanted to work even better for you. But this program is from HUD. It's from U.S. Department of Housing and Urban Development. There is a HUD office, chances are there's a HUD office local to you. In the greater Seattle region, there's a couple. One office that's like right off the top of my mind is in Redmond, Washington, and they are a great resource. So this program, the Good Neighbor Next Door program, provides an incentive of up to 50% off on certain homes, and what it asks in return is that people qualify based on what they do. They qualify based on income levels, and they qualify by using the home and staying in the community for at least 36 months. So it's a way of saying, come to us, we'd love your help. We'd love your help in supporting and building up our community. And we know it's rough for you. We know it's tough out there. So, hey, does this make it easier for you to be here? Because we'd love to have you here. So this is a very good program to use if you qualify. And by the way, thank you so much for everything that you guys do. It really goes a lot to creating stability and creating the communities that we wish we had. And there's a lot of things that go against what you guys are doing. There's a lot of things that do not help you guys do your jobs. So thank you for sticking through it. Now, the next programs that we're going to cover actually leave the grant category and move on to mortgage programs. And there are quite a few of them to cover, so I think this is a good point to pause the video on this one and just have today's video be just on grants by themselves, and then next week's video will be just on programs by themselves. Remember that grants are meant to help you get into the home. Programs are meant to help you pay off the home. So there is a difference, there's a place for both. And if you do have any questions about what we've covered today, or if you have any questions about the first time home buying process, please leave a comment below. I'd love to see it. I'd love to go to the resources such as lenders and people who are more knowledgeable about this than I am. And if I have to, I will pull them on this channel, and I'd love to interview them, knowing your questions, knowing your concerns, and not just assuming that we've covered something or that something is kind of assumed, because we don't want you guys to have to assume. We want you guys to have the knowledge and the power in your hands. So any and all questions are welcome, and I am getting ready to interview my favorite lender, and I'd love for him to have those tough questions to answer for you guys. So if you have not already done so, please subscribe to the channel, hit the bell for notification of our upcoming videos, and share this video. Please share this video to 2 or 3 people at least that you know are going to benefit from either our Market Mondays or Budget Tuesdays, or seeing other agents from different areas across the US on Wednesdays being interviewed, from the first time home buyers on Thursdays, or our fun location Fridays that we have. Please share the channel and subscribe to it, and we'll see you next time.